Welcome back to part 2 of chapter 1, where we're going to focus on cost and managerial accounting. So, managerial accounting, if you think about it, I'll call it management accounting over here. You're really just preparing information for internal users. Okay. So, you have different types or different branches of managerial accounting. And one type of managerial accounting is something that we call cost accounting. If you choose to major in accounting, you will take both an advanced managerial class and you will take a cost accounting class specifically. So here in this class, we focus a heck of a lot on costs, which again is a type of managerial accounting. But what we have going on here is we are in our plan, implement, and control cycle. And a lot of what companies are going to be looking at is how do I minimize my cost cutting procedures, trimming the fat, whatever you might hear. So it's important for us to have a game plan going into it, like for this specific product, for this specific project, how much money do I think I'm going to spend? What are going to be my costs related to it? And then I'm going to go implement that idea and I'm going to try to spend the amount of money that I budgeted. And then I'm going to say, hey, I'm way the heck over budget in this control cycle. I need to cut that down a little bit. Or I'm coming in way under budget. Do I need to be concerned about quality? Am I using good materials, etc.? Right? So a product manager might need to know how much a new product costs in order to decide a selling price for a product. Exactly. Because I need to understand, right, that it cost me $10 in cost of goods sold, COGS, in order to know that, hey, I want to have a profit margin or a gross margin on this, so I need to sell it for 15. If you have no idea how much something costs, you're probably not going to do a really good job determining, your selling price for it. A purchasing manager might need to know how much it costs to store inventory to decide how much material to order. Okay, so you subcontract or you pay rent, right, in order to store materials in a warehouse. Okay, well, you need to make sure you don't order so much materials that you need to rent an additional warehouse in order to store all of those. Okay, and then technology manager might need to know how much it costs to host a website rather than outsource it to a third party. That's a very standard internal business decision. That people make. Do we do it ourselves or do we outsource it and have a third party do it for us? And all of these decisions are going to be aided, right, by knowing how much costs are going into it. So what exactly are costs? Well, they're expenses that we have, and we will categorize them into different buckets. So you're going to have direct or indirect. You're going to have manufacturing or non-manufacturing, product or period, variable or fixed, and relevant or irrelevant. And we're going to go spend some time talking about each of these different types of costs. So the first category that we have are going to be direct versus indirect costs. So when you think about this, the direct costs, I want you to think traceable. I can directly trace these costs into my product. So say you're determining, well, how much does it cost me to take this class? Well, you can directly trace the tuition that you paid for this class into the cost of the class. You can directly trace how much it costs for you to get McGraw-Hill into the cost of this class, right? So the biggest thing here is not only is it traceable, but it's easy and convenient to do that. All right. Notice how that's different than an indirect cost. An indirect cost, it's just the exact opposite, right? Hey, I really can't easily trace this into the cost of this product. So again, maybe you're taking an in-person class and you're like, okay, well, it costs me money to drive my car to campus every day. Okay. It costs me money to have a parking permit. But again, I'm taking 4 other classes. So how do I trace the cost of my gas into the cost of this accounting class? How do I trace the cost of my parking permit into the cost of this accounting class specifically? Well, it's probably pretty darn hard to do that. Okay, they're not really traceable, but it relates to this specific product. Okay, so within direct costs, okay, you're really key thinking about traceable. Okay, the next bucket of costs are manufacturing versus non-manufacturing. So manufacturing costs are all the costs incurred to produce physical products. So say I'm producing an iPhone. I'm going to have these three pieces, and you're going to hear me say this all the time. You have DM, DL, and OH. What are the direct materials that are needed to produce an iPhone? Well, you need a glass screen. Okay. You need a motherboard or whatever the heck it's called. And that's probably made up of different pieces, but just go with it. You know, you need all the individual materials needed in order to, produce that iPhone. Then you have a component of direct labor. Well, in that direct labor, well, that's going to be the people who are actually producing the iPhones, right? All of your workers who are screwing the individual screws into the iPhones, all of the workers that are placing the screens on the iPhones, exactly. So wages to assemblers. And then you have this thing called overhead. And overhead is kind of a catch-all bucket when we're saying, okay, it's not DM, it's not DL, but it's everything else that's directly, or it directly relates to producing a product. So maybe that's the warehouse rent where you produce your product. Again, you have to pay rent in order to have a warehouse to produce that product in, but it's really hard to trace the rent into the specific iPhone that you just built. So again, direct materials are going to be your major material inputs that can be conveniently traced directly to the final product. So say you're Hanes and you make socks, you have cotton and wool. Say you're, a handbag, I don't know, Coach or whatever, the leather that's used to produce your purses. If you make automobiles, you have a bunch of steel that's used to make those automobiles. Say you make tables, you have wood. Notice here, it is easy to trace these, like they're very large. They're kind of major pieces of these different products. It's easy to trace that into it. Direct labor is the cost of labor that can be physically and conveniently traced into the final product. So again, you work at Hanes, you produce those wool socks, and we're like, okay, you sew and package them. You're actually working on the final product of what we produce. Those wages are directly attributable to the production of that product. I call that direct labor. Your assembly line workers who put parts on an automobile. Yeah, exactly. I mean, that automobile wouldn't be able to be produced if you didn't have these people working on the assembly lines, assembling them for you. Okay. So then last one here is the manufacturing overhead, which, like I said, it's almost kind of a like a catch-all where it's like, okay, I know I have DM, DL, and OH, and I know it's not DM and I know it's not DL. So it's kind of a catch-all bucket of these things that I need to incur in order to produce a product, but I can't really trace it as materials or labor. So what might something like that be? Indirect materials or indirect labor. What would an example of an indirect material be? Think about how many screws and glue are used to manufacture a wooden table. Okay, say you're like Nebraska Furniture Mart. You think Nebraska Furniture Mart is going to keep track of every single screw that they screw into every single table that they produce? Absolutely not, right? It's indirect materials. I'm going to throw that to overhead. Same thing with glue. You think I'm going to keep track of every single stroke of glue I put on a table? No, of course not. That's not conveniently traceable. Okay. Again, factory rent. Hey, I need to pay this rent in order to be able to produce my products, and I have to have insurance on it, and I have to pay utilities in this factory, and I have to pay somebody to supervise them, right? But again, I can't really trace that into the cost of a specific iPhone or a specific table for Nebraska Furniture Mart. So I lump it in and I call it overhead. So it's kind of our catch-all bucket here, where I know it's a manufacturing cost because it relates to the production of a product, but it's not direct materials, it's not direct labor, it's gotta be my overhead. Okay, so manufacturing costs, DM, DL, OH. So a lot of the times you can analyze manufacturing costs. You're going to hear this referred to as prime costs, which are the primary costs needed to produce a product. Those primary costs are my DM and my DL. So my prime costs simply equal DM plus DL. Then I have this thing called a conversion cost where I'm converting a product into being finished. So that's going to be, hey, I have all of the laborers that are working on this, and I have all of my manufacturing overhead. Okay. So notice here that you cannot add prime costs and conversion cost. This does not tell you manufacturing costs. Why does it not tell you manufacturing costs? Because these both contain DL. So I would be double dipping my DL if I put prime cost plus conversion equals manufacturing. So you got to understand the difference in what these two things are telling you. Okay. So we have DM, DL, and OH in my manufacturing. And then I have non-manufacturing costs. And my non-manufacturing costs, well, this is probably going to be selling expenses. And it's going to be, I a lot of the times will refer to this as G&A expenses. So selling costs are all of the costs necessary to order and deliver a product. So selling costs for a company like Amazon, okay, well, it's going to be all of the plastic bags and boxes that they ship their products in. It's going to be the gas, right, that Amazon drivers use to deliver these products because they're selling them, they're shipping them. Then you have general and administrative. Well, this is going to be all of the people that are kind of sitting at headquarters, right? That's going to be your company's president, your legal team, your human resource team. All of these people that definitely are not producing products, but you need to incur that expense in order to keep your company running. Okay. So you can kind of think about this as a general flow chart. And here you can see we have our manufacturing costs. Those are DM, DL, and OH. Okay. I break that out from, and I recognize that as being different than my non-manufacturing costs, which is my selling and then my G&A. Okay. So we have those two different buckets here. And now we're going to say, I have a couple of different things going on. Because if you think about all the way back to Accounting 1310, when we had a manufacturing company, we said we have our raw materials, we have our work in process, and we have our finished goods. And all three of these items show up on my balance sheet. Because my balance sheet is my assets equals my liabilities plus my equity. Well, over here, I have my inventory under my assets. And over here, I have raw materials, work in process, and finished goods. Right? Because when do I get to recognize, right, the sale of my inventory? Well, when I actually sell it. So until I actually sell that inventory, it sits on my balance sheet as an asset. Okay. Then when I do actually go through the process of selling it, well, that's when it then hits my income statement as that cost of goods sold. So again, we don't book journal entries in this class, but you should remember from Principles 1 that you debit your cost of goods sold and you credit your inventory here, right? And this is when you finally see a financial statement, income statement impact of your products being produced and ultimately sold. Now, notice my non-manufacturing cost, my SG&A, that never hangs out on my balance sheet. We always just expense that in the period that we incur it through my income statement. So again, if you think about when we recognize like advertising expense and cash, well, yeah, exactly. There was never any sort of balance sheet impact related to that. All right. So the next kind of categorization of costs that we have are going to be variable versus fixed. These are exactly like what they sound like. Variable costs change in total in direct proportion to the changes in activity level. So the more products I produce, more products, more costs. What are some examples of variable costs? DM and DL, right? Indirect materials. Those are all the things that it's like, hey, the more products that I produce, the more that the more iPhones I produce, the more glass screens I have to use, right? So my costs increase in proportion to the units that I sell. But variable costs remain, right, the same regardless on a per cost basis. So say it costs me $10 in variable cost to produce a product. Well, yeah, it's always going to cost me $10 in variable cost because I'm going to have my DM, I'm going to have my DL, I might have some OH that's variable, so on and so forth. Now converse that with my fixed costs. Fixed costs don't change in total, regardless of the activity level, okay? So what is an example of a fixed cost? Salary, right? You pay a production supervisor salary. Well, they don't get paid their salary based on the amount of products that they produce. Okay. What else? Probably rent. Okay. It doesn't matter how many products I produce. I still have to make the same rent payment every single month. Right. So again, total fixed costs don't change regardless of how many customers I serve, but my per unit goes down. Why does my per unit go down? Okay. Well, think about it. I have $1,000 in rent. I produce 100 products. I have $10. Is my math right on that? That's embarrassing. $10, right? In fixed costs per unit. Versus say I have $1,000 in rent, my payment doesn't change, but I produce 1,000 units. All of a sudden my per unit fixed costs goes all the way down to just one single dollar. Something that we'll talk a lot more about towards the end of the class, and I mean that like end of the semester here, is going to be relevant versus irrelevant. So relevant costs have the potential to influence a decision. And for something to be relevant, it has to differ between my decision alternatives, and it has to occur in the future. So think about it. It's like, say I'm trying to give a good example of a relevant cost here. Say you're trying to determine, I don't know, what car to buy, right? Well, the car that I buy is going to differ between alternatives. I can either buy this Toyota Corolla or I can buy a Lexus. I don't know, right? Those costs are going to be different, right? Between my different alternatives, between the different cars that I could potentially buy. And it's going to incur in the future because either I'm going to spend $10,000 on my Corolla or I'm going to spend $40,000 on my Lexus, right? Now, what I shouldn't do when I make this decision is think about how much I bought my old car for, right? That's irrelevant, right? It happened in the past. It's a sunk cost. What I purchased my old car for can't dictate, right, the new car that I buy. Okay. So we'll talk a lot about that, more kind of in the future in the semester. These are a little bit harder to quantify, okay, versus like manufacturing and non-manufacturing, SG&A, DM, DLOH, fixed and variable. Those are a lot easier to put like an actual numerical value on. The last kind of bucket that we have in chapter 1 is out-of-pocket versus opportunity costs. So out-of-pocket costs are exactly what they sound like. It's an actual outlay of cash. I am paying this cash out of my pocket. So just if you think about, Apple going out and buying screens from their vendors for their iPhones, well, yep, that's an out-of-pocket expense because they are paying that expense with actual cash. That is different than something we call an opportunity cost. An opportunity cost is I call it like an economic concept, right? And you should probably talk about this more in economics classes, but it's the foregone benefit of a path not taken. So I'll think about this in terms of everybody in this room chose to go to college, right? You go to college or you can enter the workforce immediately after high school. What's the opportunity cost of going to college? 4 years of not making money, right? You have an opportunity cost. You're choosing to be here instead of going out and making money. Now, you more than likely are doing that because you're saying, hey, I think I'm going to set myself up better being here to be able to go earn more money over the life of my career, right? Because I'm going to be able to get potentially a higher skilled job, etc. But there's definitely opportunity costs for every decision that you make. You choosing to watch this lecture today. Okay, the opportunity cost of that is, I don't know, maybe an extra hour of sleep. Maybe you could have gone golfing with your friends, but you said, I have just got to do this managerial accounting, right? So there are things, every decision that you make, you're not making another decision, and that is called an opportunity cost, okay? So here's a summary in a graph form of the things that we have just talked about. So our product costs are all of our manufacturing costs, which is DM, DL, and OH. Our non-manufacturing costs are our period costs, and those are SG&A, right? Selling, general, and administrative. Then I'm asking myself, can I trace it to a specific product? If yes, it's direct. If no, it's indirect. And then does the total cost change with a change in activity? If yes, then it's a variable cost, right? My DM, that's a variable cost versus my rent, that's a fixed cost. Now, oopsies. Sorry, I didn't mean to do that. I'm an accountant. I tend to like words a little bit more. So here's the word summary of to classify costs, ask yourself these 3 questions. Is the cost traceable to a specific cost object? If yes, it's direct. If no, it's indirect. Is the cost incurred to manufacture a physical product? If yes, manufacturing cost. That's going to be DMDLOH, which is equal to my product costs. And if no, then it's my manufacturing cost, which is SG&A. And then will the total cost change with respect to an activity level? If yes, it's variable. If no, it's fixed. Okay. So I would heavily suggest watching the Excel tutorial for chapter 1 because we're going to spend quite a bit of time quantifying and going over specific costs. So we're going to pull up our Excel spreadsheet in Connect. We're going to look at a bunch of different costs and we're going to say, are you product or period? If you're product, are you DMDLOH? Are you fixed or variable? And we're going to do some calculations. So I will plan on seeing you there.